Good morning, everyone, and thank you for joining us here today for the BetaShares Coolabah Capital webinar, Hybrids, the state of play and market opportunities. Just before we get started, a recording of this session will be sent around to all attendees at the end of the webinar, so you will be able to re-listen to any pertinent points. As we go through the webinar, if there are any questions, you will see a question section in the right-hand side of the tab there, which you'll be able to input questions, and we'll endeavour to answer all the questions we can as we go through the webinar today. Now, just some important information before we start. Obviously, everything we run through today is general in nature only and does not take into account any individual investor's personal circumstances. And I'm joined today by Christopher Joye, Co-CIO and Portfolio Manager for Coolabah Capital Institutional Investments. I remember when I worked on the investment bank trading floors back in the day, we all loved an analyst who was willing to express a view, and I'm very confident that we'll get that from Chris today, and so I'm very much looking forward to the webinar. And my name is Peter Harper, Executive Director of Capital Markets and Institutional Business at BetaShares. I'll now pass over to Chris to begin the webinar.
Excellent. Thanks, mate. Okay, well, thank you everyone for making the time to listen to this webinar on the hybrid market. Very excited to be able to talk to you about some of our ideas in this space and what's happening more generally. So I'm just going to rock through some analysis of the performance of the market. What happened in March? I can give you all an update of what's happened to spreads since March. But here in this first slide, we're looking at the performance of the ASX Hybrids Index. This is the market cap weighted selective index since the end of 2015. And what I have on this slide is the Aussie equity markets, which is the red line. The hybrid index is the black line. And then we've got the four major banks' share prices. All of this is expressed in total return terms. So it includes both the share price appreciation and the dividends, so total returns. And what you can see is that the ASX hybrid market over the last 5 years has been very low volatility. You can actually see it in the table there. The annual return volatility has been 5.5%. This is after the kind of 1 in 100 year Great Virus Crisis, or GVC as I like to call it, shock. So there was obviously a huge, basically unprecedented increase in volatility, which has in turn increased the vol estimates over time. So return volatility at 5.5, that's about a third of the volatility of the equity market. So you can see on the first column here, this is the equity market, this is the vol of the hybrid market, and 5.5% per annum versus 16.3% vol for Aussie shares. And then you can see the major banks are much more volatile again. So really between 25 and 30% vol for the four major banks. Now, you can also see here in this table, we have the March 2020 returns. So the Aussie equity market was down 21%. The ASX Hybrids Index was down 6%. The four major banks were all down about 25 to 35%. So underperforming the wider market. The performance of the hybrid market in March was actually better than we would otherwise expect. In the global financial crisis, the so-called beta or correlation or relationship or elasticity of the hybrid market to the ASX equity market was about 0 or 50%. So we would expect in this sort of scenario where Aussie shares are down 21%, the hybrid market, using the GFC as an example, would have been down about 10% to 11%. And instead it was down 6%. So the market performed in a very resilient and durable fashion, notwithstanding we had a huge blowout in hybrid spreads that I'll come to. I've also got here some analysis of the ASX hybrid market compared to the global high yield market. And I'm using here the Bloomberg Barclays Global High Yield Index, which is the main benchmark for most high yield funds and high yield investments. And the black line again is the hybrid market. The red line, the slightly more volatile line, it looks like has been the is the global high yield index. And you can see that the drawdown in high yield in March was substantially more than what we saw in the ASX hybrid market. So it's not shown on the table there, but the Bloomberg Barclays Global High Yield Index fell 13% in March versus the ASX hybrid market falling 6%. So we did substantially better than the global high yield market. Hybrids, for those who don't know, major bank hybrids have credit ratings that are BBB-, which makes them investment grade. But smaller banks like Macquarie have hybrids that are rated by Standard & Poor's as BB+, which actually makes them high yield. So I think it's reasonable to think of hybrids as an alternative for high yield. They certainly have either high yield ratings or investment grade ratings that are on the cusp of high yield. There's a one-notch difference between BBB- and BB+, or between the major banks and Macquarie. What you can also see is over this period, the ASX hybrid market has outperformed the global high yield market quite substantially. Over the last 5 years, this is right after the March shock. So obviously returns were weighed down by the March shock, but the 5-year annual return was 5.3% versus 2.7% for high yield, with slightly lower volatility of 5.1 versus 5.6 for high yield. And that's also true over the last 12 months. This was to April. ASX hybrids actually up 2.5%, high yield down 5.5%, with a similar vol over the last 1 year, elevated vol. What actually happened in March? So we had an unprecedented blowout in hybrid spreads in March. So we saw, and this is a chart that shows, for those again who are not experts on this stuff, it shows the credit spreads on major bank securities, and the light blue line here is the major bank senior bonds, the black line is their subordinated bonds, and the red line is hybrids. For those of you who have seen this chart before, I've got the latest data, so you can see the mean reversion. Some of our clients have said, Chris, we want to see an updated version of this chart. Well, it's updated for those of you who have been harassing me about that. And basically, this is the GFC. This is the first Eurozone sovereign crisis. This is the second Eurozone sovereign crisis, and this is the GVC, the Great Virus Crisis. And what you can see is we saw a fairly spectacular and unprecedented increase in spreads to 8.41% over the quarterly bank bill swap rate. So this is for a 5-year major bank hybrid, rated BBB- investment grade. And we saw spreads blow out to bigger levels than what we saw in the global financial crisis. And this is why I was fairly highly convicted that this was a tremendous buying opportunity. Across all of our portfolios, we spent about $300 million buying hybrids in March, literally. So we put our money where our mouths are. Obviously, those verbal communications can be fairly opinionated and high conviction, but we had a view coming into March that really informed that contrarian position. Without going into a huge amount of detail, because we've held other webinars on this subject, we basically built a whole bunch of COVID-19 forecasting systems. I have a team of 23 people, 11 analysts, 4 portfolio managers. 3 of the team have PhDs. We have 10 engineers, mathematicians, and physicists in that team. And we built live COVID-19 tracking systems where we were tracking every infection, every fatality in the world. We've built screens that display this live, and then we built forecasting systems. And in March, I published in the AFR and Livewire our forecast, which said that COVID-19 would peak in early April in Australia, in the US, and in Europe. So we were not of the view that the epidemiologists were peddling that COVID-19, that the infections would not peak until June or July, that the peak in infections was not many months away. So we were one of the few organizations globally that had that very unconventional view in March that the peak in US and Australian infections would be in early April. As it transpired, that's exactly what happened. So Aussie infections peaked at the end of March, US infections peaked on the 13th of April. Our model was an empirical model. The epidemiologist model was a theoretical model. And what they got wrong was the efficacy of the containment strategies, the effectiveness of the lockdown. So insight number 1 was that this was likely to be a very short and sharp spike in infections globally. Obviously, we're getting new waves of infections in developing countries like India, Indonesia, Russia, and Brazil. But for developed capital markets, they're really focusing on China and the developed world. So that was insight number 1. Insight number 2 was that in February, actually on the 28th of February, I wrote in the AFR that we thought that the inability of markets to price a pandemic would basically trigger a huge liquidity and solvency crisis. I was advising the Prime Minister, the Treasurer, we were speaking to the Governor and Deputy Governor of the RBA and the head of APRA and major bank CEOs. I was speaking to bank CEOs pretty much every single day through late February through to mid-March. And basically we argued in late February that unless central banks rolled out their QE bazookas, their quantitative easing bazookas, and unless they provided a liquidity and an asset purchasing bridge between now, when the virus had hit, and the future when vaccines were available, we felt that there would be a complete contagion, a total liquidity and solvency catastrophe. Now, the RBA, we were arguing this privately and publicly in late February. The RBA disagreed with us. In early March, and indeed in the second week of March, the RBA was telling the world there was no liquidity shock. This wasn't like the GFC. They cut rates, but they did no QE. Likewise, the Fed cut rates on the, I think, 3rd of March and did no QE. In fact, Chairman Powell, the head of the Fed, ruled out any QE. And this was a disaster, right? And this is precisely why these credit spreads went through the roof, right? And as you know, equities fell 30 to 40%. We saw unprecedented increases in senior bond spreads, subordinated bond spreads, and hybrid spreads. But the real damage was done in the hybrid market. Notwithstanding, as I mentioned on the prior slide, notwithstanding that the actual drawdown peaked, in March was 6% versus the 21% drawdown in equities. That was in the month of March, not peak to trough. The peak to trough drawdowns were a bit bigger. For equities, it was 29% peak to trough. And I believe for the hybrid market, it was about 7 to 8% peak to trough. Notwithstanding that, we felt that the advent of QE would be inevitable, and whether the central banks decided to preemptively cauterize the crisis, as they should have done in late February and in the first or second week of March, or whether they acted reactively in response to the huge blowout in spreads, the huge diminution in liquidity, and the risk of basically businesses blowing up left, right, and center. We felt that QE would have a tremendous contractionary impact on spreads. So we thought there'd be massive mean reversion. And we argued this very vocally in February, in March, and in April, that basically the blowout in spreads would be reversed. And that's why I spent $300 million buying hybrids in March, because I thought that these would be basically once in a generation buying opportunities. So what happened in March? Now, for those of you that invest in BetaShares active hybrid ETF product, which Coolabah Capital Investments run, so my 23-person team, we run overall AUM of about $5 billion. We run HPID as part of that. HPID has FUM of about $700 million. And HPID is a very, very well diversified 30 to 40 security portfolio of hybrids, subordinated bonds, and senior bonds. But it's absolute return and it's full capital structure. What that means is I don't actually have to invest in hybrids. If the hybrid market's overvalued, I can go up into subordinated bonds and senior bonds. Now, we had fairly aggressively de-risked HPID coming into the crisis, and that's why we significantly outperformed the hybrid market in March. So net of fees, we outperformed in the month by about 150 basis points. Now, the good news is, so the index was down 6, we were down 4.5. You can see the Barclays Global High Yield Index was down 13.5. Perpetual's LIT was down 13.5. The equity market was down 21. Neuberger Berman Partners and KKR's LITs. These are all high yield bond listed investment trusts. So they are competitors to the Barclays Global High Yield Index. And in theory, you could say that they are alternatives to something like a hybrid portfolio. They were down 21, 25, 27, and 32%. So obviously a bit of a tough time there. The good news is that in April, HPID was up, I believe, from memory, 3.6% net of fees. So we're up, having fallen 4.5% in March, we're up 3.6% in April, and in May, we're up another 1% plus. So we've fully recovered this March loss, notwithstanding the equities market still remains well below its February levels. So that was a good result. And this was really a function of, again, the huge blowout in credit spreads that we saw And the performance, I just stress again, we normally would expect the hybrid market to be down 50% of whatever equities did. Equities was down 21, the hybrid market was only down 6, not 10, and we were only down 4.5. So very, very pleased with those outcomes. So in terms of what's happened since then, so this is now moving into April and May. What this chart shows us is the credit spread. So again, this is the cost of borrowing for the 4 major banks across 3 of their different types of bonds. So they're AA bonds, they're Tier 2 bonds, and they're hybrids. This is to the 8th of May, but I can give you the data today. So I'm going to give you a fresh mark to market right now on what's happened to spreads. So again, focusing on the hybrids, pre-crisis hybrid spreads for 5-year major bank securities were at 273 over bank bills. They blew out to 841 over bank bills. At the 8th of May, they're at 417 over bank bills. And if we just go back to my chart here, you can see they're now at 396, right? So we've had this massive blowout, but mean reversion, massive blowout, mean reversion, massive blowout, mean reversion. And again, that's why I bought 300 million bucks of hybrids, but I actually spent $1 billion in March buying securities, and I was buying these, mainly these senior bonds. We have bought and sold about $6.8 billion worth of bonds over the first 5 months of 2020. So we got the mean reversion we expected, and putting our money where our mouth was has paid really substantial dividends in terms of our performance. So this is now at 396. Tier 2 subordinated bonds, which HPID can and does invest in, those spreads went from 160 over, these are BBB plus rated securities, to 400 over in March, and those spreads have compressed down to 260 over. Actually, about, if we go back to my chart, about 250 over today, right? Now, interestingly, HPID coming into this crisis had no Tier 2 bonds. We were basically 100% senior outside of our hybrids. So we were sitting at about 80% in hybrids and the rest in senior and cash, which is why we significantly outperformed the hybrids index in March. We actually sold our senior bonds in March to buy these hybrids. So we actually increased HPID's portfolio weights to hybrid securities from in the circa 80% range to 99.3% at the end of March. Off the top of my head, don't quote me on that number, but I think that's broadly correct. So we went limit long hybrids because, again, this was a once in a generation, arguably a once in a lifetime buying opportunity. I also had insto clients that poured hundreds of millions of dollars in March into hybrids and also senior bonds. They were the 2 markets we focused on. We weren't really focused on the sub-debt market. As I mentioned, HPID had no sub-debt securities. However, we have started buying them. So sub-debt spreads went in from 400 to 260 to now at 250. Senior bond spreads blew out from 69 to 175, and they're now into 77. Actually, today they're at 71. Now let's look at how HPID. This slide's slightly dated. It's only through to part of May. As I said, we were down 4.5% in March. We were up 3.6% franked in April, and we're up another 1% in May. But the interesting thing about this particular chart is we're showing 2 lines here. This is the white line, which is the price of HPID, and the blue line is the net asset value. So the blue line is the net asset value. Now, one thing we learned during this March crisis is the tide receded, and all the junk bonds that I'd actually been criticizing for 12 months, I've been saying, don't invest in high yield debt because there's huge risks, and credit spreads in high yield markets were at all-time tights. That is to say, they were even skinnier than they were in 2007. So even though I can invest in high yield bonds and have invested in high yield bonds in some portfolios in the past, we had 0 exposures coming into the great virus crisis in February. And what we saw is that HPID's performance tracked its net asset value very closely through this 1 in 100 year shock. There was no huge disconnect between price and NAV. And we were probably the only fixed income ETF in the world or fixed income listed investment trust in the world that really displayed these characteristics, or one of the few ETFs and LICs or LITs that display those characteristics. So if you look at, for example, the Ausbond floating rate note ETF, which is the FLOT ETF, this is what happened in March. So the price, you can see, goes way below the NAV. And we saw similar things with the listed investment trusts. So we saw the LITs, the Neuberger Berman, the Partners Group, the KKR, and other LITs trade at huge, generally, I think 20 to 40% discounts to NAV. and suffer, as you saw on this slide here, really quite substantial losses in true price terms. So, really down 21 to 33% and 20 to 40 below NAV. So we were very proud of the fact that HPID traded in line with NAV through this stress event. A good question is, why did it trade in line with NAV? And one of the answers to that question is because of the liquidity in the market. So what we're seeing here is rolling 7-day ASX hybrid trading volumes. And you could see that prior to the crisis, trading volumes were pretty consistent at around $200 million turning over every 7 days, right? As we came into March, what we saw were two things. In the over-the-counter or unlisted corporate bond market, liquidity evaporated. It absolutely vaporized. And that's why all those fixed income funds had to increase their exit spreads. So we saw lots of these managers increase exit spreads by 1, 1.5, 2, 2.5, 3%. They were de facto gating their funds because there was no liquidity in investment-grade corporate bonds in Australia, like zero liquidity. We've seen some really bad war stories associated with this. Now, HPID held no corporate bonds. In all of our portfolios, we had no corporate bonds. We're 100% invested in the securities issued by government-guaranteed banks, banks with government-guaranteed deposits, banks with access to emergency RBA liquidity facilities. And what we actually saw on the ASX was, perhaps counterintuitively for some who might think that there's not much liquidity in the hybrid market, we saw a huge increase in liquidity. So we saw up to $534 million trading every 7 days. On individual days on the ASX in March, we saw up to $120 to $130 million turnover. Extraordinary liquidity. Now, this wasn't a surprise to Coolabah, because one thing we've learned over the last 8 or 9 years is every time there's a stress event, one place you can get great liquidity is in the hybrid market. There's always a bid and there's always an offer. And the ASX is a very good aggregation mechanism for bringing buyers and sellers together. Just looking at actually our trading profile, this is a screenshot from our internal systems. And what you can see here is the actual sales in the hybrid market that we were affecting. And so on the x-axis here, you can see time. So this is January through to 2020. Each black dot is a hybrid sale. And here you can see the returns, pre-fees, any other factors. But you can see 5, 10, 15, 20. And what you can see is that basically we had some redemptions in HPID. So there were some investors that chose, unfortunately, to exit at the worst possible time in March. And we were forced to sell some hybrids because, remember, I'd gone limit long. So we had no problem selling those hybrids, but we had to crystallize some losses because there were individual securities that were down as much as 10, 20%. But generally speaking, we were massive buyers over this period. As I mentioned, buying $300 million of hybrids in March. And then we've been massive sellers ever since, so taking profits as spreads have compressed. So as credit spreads on hybrids have converged from 841 down to 417 down to 396 today, we have been taking profits within HPID. And you can see across all of these trades since January 2019, we've actually sold about $338 million worth of hybrids. We look at our win ratios, which is if I buy a hybrid, sell a hybrid, do I make money or lose money? And on a total return basis, including coupon, we've made money 99.3% of the time across. If you look at the number of sales, about 2,933 hybrid sales, and we're getting capital gains about 94.5% of the time. Why are we getting capital gains? So basically, our job is to find the cheap hybrids that are paying too much spread, too much income for their risk, and then when the market figures out they're cheap, the spread normalizes or mean reverts back to our Coolabah's fair value target, and then we capture that capital gain and move on. And so you can see that a very, very high percentage of the time we're able to do that. And these capital gains here per annum augment the coupon to give a higher total return. So just to give you some sense of the returns, these are not returns we have crystallized across the board in the portfolios. These are just looking at single security returns that if you bought hybrids at the wides at 841 basis points. So if you bought the hybrid market when spreads blew out here to 841 basis points, since that time you've captured capital gains of 19 to 20%, which is pretty cool. And similarly in the, and this is using the 8 May numbers. So this is using the credit spreads as of 8 May, so 417. Obviously, if we updated them through today, those capital gains would be high because spreads are now at 396. And similarly, you've got really massive quick capital gains in Tier 2 subordinated bonds, 6 to 7% at the time of this chart being printed, but probably closer to 7 to 8% today. And even on very, very sort of boring, super liquid, safe, AA- rated senior bonds, you picked up massive capital gains. If we look at the hybrid market, this was printed a few days ago. Today, where are credit spreads, where are yields, and what do returns look like if we make some assumptions about where those spreads go over the next period of time. So basically spreads, as you can see, are in the kind of low 400s. These are major bank hybrids. These are the credit ratings, these are the securities, this is their call date. This is the current running yield, so it's the spread plus basically the current bank bill swap rate. This is the yield to maturity. So the yields to maturity are somewhere between 4.5 and 4.8. Spreads are in the low 400s, so you then add in the expected bank bill swap rate over the period of time that you're going to hold the hybrid, and we're valuing these to their call dates. These are when they're expected to be repaid. And here we've got the total returns on hybrids in the event that credit spreads go from circa 400 over to 250 over, where they have been in the past in the last sort of 12 to 24 months. And so if spreads continue to compress, you've got very, very high total returns. Obviously, that's a big assumption. They may not compress. Spreads could go wider if we get more shocks. Our view is that spreads are going to compress significantly down to the 300 mark and then through that level. So you're looking at total returns of between anywhere between 5.5% through to 12.7%, depending on the individual securities. Macquarie Bank is going to list a new hybrid tomorrow. This is a very exciting new deal. This is a security that has an expected repayment date in 5.5 years' time. At the time they launched the deal, the ASX ticker was MBLPB. Someone said to me that they're changing that ticker. I need to check that. So it lists tomorrow. It's a $500 million hybrid. I bid for 125 million of it across all of my portfolios. We got a fair chunk of it, and the issue margin was 4.7% above bank bills. So that's an all-in gross running yield of about 4.8%. So that was the issue margin. Now, this is basically showing us a chart of where the market sort of implies it should trade. So this is years to call or years to expected repayment. This is the trading margin over bank bill swap rate. And these are here and here, two different current Macquarie hybrids that have call dates either side of the new hybrid, MBLPB. So, and they're trading at spreads of 4.1 and 4.35. If we interpolate between those curves, it's basically saying a fair value expected credit spread of about 4.24. And we bought the hybrid on a spread of 4.7. So that's kind of our mission, to find securities that are cheap at 4.7. Hopefully this little sucker compresses or mean reverts or normalizes down to 4.24, and then we pick up a capital gain at a spread of 4.24 above bank bills. The capital gain on MBLPB would mean that its price would appreciate from $100 to $102.11. Now, these are actually two hybrids issued by Macquarie Group. This is a Macquarie Bank hybrid that has a higher credit rating and that is basically safer. So we'd actually expect this to trade inside these two securities. So our view is at least 10 basis points inside, so more like 411 over rather than 424 over. And that in turn would imply that the clean price expectation is more like 102.60 or 102.56 to be precise. How do hybrids look on a relative valuation basis vis-a-vis the major bank senior bonds? So some people think about hybrid valuations relative to where senior bonds are trading. So this red line shows us basically the multiple of hybrid spreads over senior bond spreads, and the black line shows us the multiple of the major banks' Tier 2 subordinated bond spreads over hybrid spreads. And I published this about a week ago, and at the time, the average three-year average hybrid multiple over senior bond spreads was 3.91 times, and the current multiple was 5.5, and sitting at like record highs. So that's good. It implies hybrids are very cheap. Similarly, for Tier 2 subordinated bonds, which HPID can also invest in, the three-year average multiple to senior spreads was 2.1 times, whereas Tier 2 was sitting at 3.4 times. So we've actually been buying Tier 2 in HPID over the last month or so as we take profits. Where do we think spreads could get to? So where's the best case, possible QE-driven steady state scenario? Well, we've run our valuation models. I'll show you those models in a second. We use up to 30 internal quantitative valuation models, and we're constantly refining and updating these models. And I'm just going to show you one specific model. But that model sort of implies that as of the 8th of May, hybrid spreads are at 417 over, as I've mentioned there, right now at 396, but they could potentially get down to 200 over. We have seen them at various points in the GFC. If you look at hybrid spreads over time, they got to 181 over in 2011. So they have got quite skinny at various points in time. In 2007, 5-year major bank hybrid spreads were trading at about 125 over. So this is not inconceivable, although it would be a brilliant outcome. And if that happened in that scenario, and please note our forward-looking disclaimer, but if that happened, you're looking at total returns of about 14% over the next 12 months. In Tier 2 subordinated bonds, we think spreads could go from 260 to 150. That implies forward-looking total returns of 7.6%. And in senior bonds, from 77 to 50 over, with total returns of about 2.1%. Might not sound that fantastic in senior, but remember the cash rate's at 25 basis points, and the bank bill swap rate is actually below that, and only offering about 10 basis points. To put that in context, in May, if you invested in the RBA cash rate, your return was was only 2 basis points, so 0.02% from cash and from RBA cash, and about 1 basis point from bank bills. So 2.1% of total return over 12 months is actually pretty amazing. In terms of our valuation models, let me just tell you how this works. So this is a screenshot from our internal systems, and this is using something called a Merton model, which is actually an option pricing based framework. And before the thousands of people who are watching this right now all jump off the line, don't be bored. I will make this sound relatively sexy. Basically, what this model is doing is it's looking at, here we're looking at CBA. This model is looking at CBA's equity volatility, which is this axis here, and it's saying, based on an assumption about recovery rates and based on the model's estimate of the likelihood of CBA's assets crossing their liabilities, and effectively CBA is zeroing its equity, this is the fair value credit spread you would need to compensate you for that risk. And for senior spreads, we are looking here at a probability of default of 2.33%, and we're assuming a 35% recovery. And on that basis, the minimum spread is about 30 basis points. For subordinated bonds, we're assuming a 0% recovery, a 6.22% probability of default, and a minimum spread of about 128 basis points. Pre-GFC, senior was at about 10 basis points. Pre-GFC, sub was about 35 basis points. And for hybrids, we're using an 8.8% probability of default, 0% recovery, and minimum fair value spread is 184. So coming back to our slides, 200 over is above that minimum, similarly 150 and similarly 50, okay? What else about the hybrid market that's interesting right now? I know a lot of people are asking me the question, a key question, what does it mean that banks are deferring, or they're deferring their dividends, or they're radically reducing their dividends, yet whilst always repaying the coupons on their hybrids? So a few things. They're being very conservative. This is absolutely an emphatic net positive for hybrids, because as the banks don't pay dividends, what they're doing is they're building up their equity capital buffers, and that equity capital buffer directly protects hybrids from the risk of default. There are several kind of complex risks associated with hybrids, but one of the main ones is that if a bank's equity capital ratio falls from circa 11% today down to 5.125%, which is a level set by APRA, the banking regulator, then the hybrids are automatically converted in that stress event into bank shares. So the more capital the banks have, the better. And the banks are all building those capital buffers through rights issues, through capital raisings, through dividend reinvestment plans. Today, ANZ announced it had sold one of its New Zealand businesses, I believe, for circa $700 to $800 million. And deferring dividends is a really powerful way to build capital. So that actually directly reduces the risk of default on hybrids. In addition, the fact that Australia is coming out of containment so quickly, so we're rushing out of containment in May, June, as Coolabah projected. So, we argued in March that the Prime Minister's 6-month proposed business hibernation plan was totally wrong. I told the PM this. He argued at the time I was wrong privately. I said, no, you only need to lock down for 1 to 2 months and you'll be coming out in May, June. he's obviously swung 180 degrees to that view. That's great for the Aussie economy. It means we can get people back online, businesses opening back up. Pubs and restaurants can have 50 people now on their premises. So that's going to minimise credit losses, and it will be likely the case that the bank's credit losses will be lower than expected. You've heard recently that the government has saved $60 billion on JobKeeper. Everyone is talking about this being a budget error. Actually, it's not. It was simply a conservative forecast from Treasury, assuming the economy was shut down for 6 months. As it transpired, they only shut down for 1 to 2 months, so hence less need for JobKeeper subsidies. In addition to that very big positive of banks deferring or reducing dividends and therefore building capital, NAB and Macquarie have also repaid 3 different hybrids since March, worth $2.1 billion with APRA approval. So another concern had been people were saying, oh, maybe they won't pay coupons. Well, they're all paying the coupons. Maybe they won't repay the hybrids. Well, all the banks are repaying their hybrids. And this is despite the fact that NAB and Macquarie cancelled $2.6 billion of new hybrid issues that were launched in March and were going to list at much wider credit spreads. And they did that simply because they thought it was a bad deal for retail investors. And as we know, Macquarie has come along with this new hybrid issue set on a spread of 470 over. In March, they'd raised a similar amount of money at a spread of just 300 over. So investors are getting 470 as opposed to 300. That's a fantastic result. And I'd expect NAB to come in October or thereabouts. Bank of Queensland and Suncorp, some of the smaller banks, have also repaid $340 million worth of hybrids since March. Very, very positive sign. And I think the key point here is that really the only place the banks can raise franked hybrid capital is in Australia and mainly on the ASX. And so they're very committed to protecting that market. When they issue hybrids in US dollars, they can't attach franking credits, and that makes it much more expensive for them to issue. What about some of the downside scenarios? So let's just quickly talk about those. APRA runs a stress test of the banking system where it says house prices fall by 35%, unemployment rate jumps to 11%. And basically, in that scenario, APRA finds that the bank's credit losses are such that their equity ratios fall from 11% to 8 to 9%. That is crucially way above that bail-in threshold, that equity conversion threshold I talked about before, which is an equity capital ratio of 5.125%. So even in this worst case scenario hypothesized by APRA, the hybrids are not converted into equity. We run our own stress tests that are much worse than APRA's, and we can get the equity capital ratios down to the 6 to 7% range. But again, we don't see the equity conversion of any hybrids, which is good news. The 4 major banks are among the best capitalized banks in the world. As you probably know, they're amongst the safest banks in the world. It's why their hybrid ratings are so high in the investment grade band. I've actually already talked about this slide. This is our modeling looking at our forecast for the bank's equity ratios in different scenarios. So we have a base case here, we have a GFC case here, we have a 91 recession case here, and we have a 91, and then we increase it, we make it worse by a factor of 25%. So we increase the losses in 91 by 25%. And that's where we can get to these really low CET1 ratios of 6 to 7, still above the equity conversion trigger. In contrast to the hybrid market, we are very negative on the BBB corporate bond market, and we're very negative on the global high yield market. Now, I'm not conflicted on this. I can have 100% of my $5 billion pretty much in corporate issues, and we can also invest in high yield bonds. So we have invested in the past in high yield debt. I invested in a subordinated SEEK bond late last year, which I sold in January. That was a high yield instrument, and we sold that for handsome profits. But what this chart is showing us is the quantum of BBB rated corporate bonds around the world that are currently on outlook for a downgrade to high yield. So, or a downgrade generally. So that's about $1 trillion. If you add in the bonds, that are also on watch for an imminent downgrade in the next 6 months, it's called credit watch negative. So these are the bonds on credit outlook negative. If you add in those two categories, or you combine them, you've basically got $1.2 billion worth of corporate bonds that could be downgraded to high yield. This is much worse than what we saw in the GFC. So very, very bad for credit funds, anyone investing in corporate bonds. And we've already seen here examples. I'll talk about those in a second. What we're seeing here is on a quarterly basis, the value of bonds that have been downgraded from BBB to high yield. So these are the bonds that have actually been fallen angels that have actually been downgraded. And the total value here across the US and European markets in the first quarter of this year was $184 billion. We've never seen anything like it before. 2.1 times larger than the GFC, 2.5 times larger than what we saw in 2016. So this is very, very bad news. And there's a hell of a lot more coming, another 1.2 trillion at risk. So this is the stuff that's already been downgraded. This is the stuff plus this extra 200 billion over here that is on the cusp of being downgraded. At the same time, we're seeing high yield default rates rocket. So they are increasing dramatically. And we in Goldman Sachs believe those high yield default rates will broadly approximate what we saw in the GFC. In fact, I think they could be worse than what we saw in the GFC. And so that's very bad for the high yield market. Right now, the Fed has announced that it's buying some high yield issues and it's buying some high yield ETFs. So you're getting a bit of a dead cat bounce in high yield. High yield did quite well in, it did okay in April, it did better in May. But if you can get liquidity in high yield, certainly my view is I would be taking that liquidity. I'm not offering any personal advice, obviously. This is general advice, and please read all about relevant disclaimers. So a classic example of this was the Virgin bond that listed on the ASX in November. $325 million issue, spruiked by all the usual suspects, and obviously that's been a zero. Virgin was a classic basket case, highly levered business, unprofitable, a zombie business as we refer to it. And in fact, I tried to get shorter bonds in March in one of my long short strategies. We borrowed the bonds, but literally couldn't find a bid, unfortunately. But I think the zombie companies that are highly levered, that are unprofitable, are really cruising for a bruising. I think also you're going to see a lot of pain in the dividend yield rich defensive stocks where people have been used to the assumption of strong dividend payout ratios, but dividends are being slashed. So the major banks are a classic case in point in that respect. Using major bank equities as a kind of bond proxy, I think, was a really foolhardy sort of approach. And we've seen since I showed you the first chart of the pack that since 2015, the major banks sadly have actually had an annual return of -7, -3, -6.5, and -11. And so we think that there is a lot of risk and a lot of vulnerability in the high yield and mid markets. And I just want to kind of conclude on that point. So the governments of the world, with their fiscal bailout packages and their QE and their liquidity operations with the central banks, they're really putting their arms around systematically important businesses, businesses that are too big to fail. And they're also bailing out mums and dads, workers through JobStarter, through JobKeeper, and really small SMEs. But there is this vulnerable middle market between the too big to fail banks and between sort of Main Street, where you have mid-sized companies, the Virgins, the Cruise, the JCPenney's. We're hearing all these businesses blow up every day, airline after airline. And these vulnerabilities, these fragilities where these businesses had taken on too much leverage and they were either very modestly profitable or not profitable, are being found out. And I think you're going to see a lot more of that to come over the next 12 months. We are also very, very exercised about China-US relations. I've got a webinar, a Coolabah webinar on this on Friday, if you want to dial in, and just on Cold War 2.0. And we think that's a big sort of thematic that we're going to be talking about for the next 5 to 10 years, the breakdown of China-US relations and decoupling of Western supply chains from China, which is likely to create a huge macro headwind for the Middle Kingdom for many years to come, in concert with the fact that China has extremely big demographic problems and very, very high levels of leverage. At that point, I might hand over to my colleague, Peter Harper.
Thanks very much, Chris, and thank you everyone again for joining us. Now, we'll just very quickly look at the implementation and some quick details on HPID. We are hitting up against time, so I'll keep this to a minute or two and then open to questions. If we just have a look here, what we can see is that hybrids look arguably pretty attractive from a yield perspective at the moment, in that we're seeing a gross running yield there of about 4.37% on bank hybrid securities, which is quite a bit above some of the other areas that we've shown there. But what I think is most pertinent is at that running yield of 4.37%, hybrid securities now sit above the gross forward dividend yield for the ASX 200, which is just 4.24%. And arguably, given historical outcomes with bank dividend cuts, that comes at a higher certainty of income in the hybrid market relative to the equity market. But not only that, we've seen all of these outcomes with historically lower drawdown risk. Now, I'll only touch on this because Chris probably covered it fairly well, but GFC, banks were down 50%, hybrids down 27%. COVID-19, banks down 35%, hybrids down about 7%. So much lower drawdowns for hybrid securities, both in those periods and across other general equity market declines. I might just skip the next slide and go straight to slide 37. And so you can access the BetaShares Active Australian Hybrid Fund managed by Chris and his team at Coolabah Capital under ticker HPID on the ASX. Some key points to note here. The hybrid market itself is hard to value. It's relatively inefficient, and that creates a great opportunity for an active manager. Coolabah have extensive valuation models, some of which Chris ran through today, that are just not available to the average investor. So that can help them to identify mispricing and to help mitigate risk of overvaluation in hybrid securities. The terms of hybrid securities are also relatively complex and differ a lot from one security to another. So we think that's something that sits well in the hands of a professional manager. And finally, a portfolio like HPID gives exposure to somewhere between 35 and 50 hybrid securities. So quite a deal of diversification there, relative to many direct portfolios we speak to, which only hold say 3 to 5 hybrid securities. So I think that's very beneficial for investors. Next slide. Just a few other quick key points on the HPID portfolio. It targets returns that are greater than the Australian Hybrid Index and has been delivering that outperformance. Post-fee returns in an absolute sense of the RBA cash rate plus 2.5% over the medium term as an absolute return objective. And generally, we seek to provide a yield that's consistent with the yield on the Australian Hybrids Index also. It's done at a post-fee volatility target of between 3 and 4%. And I think it's very important, and Chris mentioned it several times, just to highlight that whilst the portfolio has sat in the majority in hybrid securities, it does have the ability to move up and down the capital structure to take advantage of some of the risks that Chris or some of the opportunities in other areas higher up the capital structure that Chris highlighted today, but also to mitigate risks in the hybrid market should they eventuate due to overvaluation or bank capital levels at some point into the future. So with that, I think we'll open up to questions. There's obviously some risks there to consider, investment risk and the like, but now I'll open up to some of the questions that have come through over the course of today. So let me just get them up here. We do have quite a number. Chris, we've got a question from Rita. What do you think of regional bank hybrids? Do you think their spreads will compress like the bigger ones? Is there a possibility that they will skip coupon payments given the stress they're under?
I don't expect regional bank hybrids to skip coupon payments, but they're much less liquid than the major bank hybrids. And obviously there is a commensurate increase in credit risk. But we do have some regional bank hybrids in HPID. I think that there are periodically really good opportunities in that space because the issue sizes tend to be smaller. There's also sometimes a bit of a scarcity bid.
Great. Question here, what does HPR do with dividends and attached franking credits from the hybrids when HPRD receives them? You happy for me to take that one, Chris?
Oh, well, just very quickly, I mean, we distribute franking credits to investors. You'll receive those on your tax statements. And we actually manage the portfolio very, very carefully to make sure that we don't trigger or run in a breach of minimum holding period rules in relation to our ability to claim those franking credits, unless we think that there's some huge capital gain we want to crystallize, and we're happy to forego the franking credits. But we're very focused on optimizing the franked returns. Having said that, HPID also does invest in, at various points in time, lots of senior bonds, major bank senior bonds, major bank subordinated bonds, bonds issued by other financials particularly, and cash, none of which is franked. So only the hybrid part of the portfolio will be franked. And just coming back to actually that question on the regional banks, I would add that I think it was very, very encouraging that Bank of Queensland and Suncorp, as I mentioned, repaid their recent hybrid issues. I think the risk is greater that they won't repay them, as in they will defer a call date, than it is that they won't pay a coupon. I'm not aware of any Australian bank that has never, or that has not paid a hybrid coupon. Sorry, Peter.
Yeah, that's all right. I was just going to make the point that it's distributions are paid out monthly in HPRD, and you receive a tax statement at the end of the year, as you do for any other fund or for any other direct share investment for that matter. A question here on what percentage of HPRD is invested in Australian bank bonds?
Well, HPID has no corporate bonds because of our concern with the corporate bond market, the fallen angel risk, as I mentioned, the risk of BBBs being downgraded to high yield. We had two, not in HPID, but we had across all of our portfolios, we only had 2 corporate bonds in January, and we have actively sought to hide in the safe harbour that is provided by government guaranteed banks. So almost all of HPID's portfolio is in cash, bonds issued by banks, and then hybrids issued by banks and insurers. So groups like Suncorp, Challenger, Bank of Queensland, Bendigo, Macquarie, and the 4 majors.
Excellent. Just going through questions here. Chris, quick question. We've been asked for the definition of a credit spread. Can you explain what one is?
Yeah, a credit spread is simply, I guess, the additional return that you earn above a benchmark for the cash rate when you invest in these securities. So if the spread is at 4% above the bank bill rate, and the bank bill rate is at, say, 0.1%, you're getting 4.1% as a total repayment on the security in question. So it's meant to proxy for the risk of default and any losses that you incur in default. So when I showed you our valuation models, we actually explicitly model default risk and we model recovery risk, and so therefore we model what is called the loss given default to try and figure out, well, what's the minimum credit spread I need to get comfortable to buy these assets.
I think in the interest of time, we'll leave it there. Apologies for the questions we have not got to today, but as always, we'll endeavour to answer those questions separately and come back to you on those. So thank you very much to everyone for joining us today. Thank you to Chris for your insights. We greatly appreciate it. And thank you to all our listeners today.
Yeah, thanks, guys. Really appreciate the thousands of folks that joined the call, and it was awesome. And it's a real honour and it's humbling. Thank you.